So moving on to concerns around valuation. Again, valuation is a tricky one because usually when you see concerns around valuation brought up, it's brought up and then saying compared to the last 20, 15, or 10 years, this multiple is much higher than it normally is, or it's at the high end of its range. And you could say that's true. I can pull out this study and talk about price to sales, price to cash flow, price to earnings. All of those multiples are at the high end or even potentially even in new territory versus their longer term history. Now, in and of itself, in that vacuum, that is definitely attention getting. There's no way to put it a different way. It is attention getting. However, these multiples and these valuation metrics do not exist in a vacuum. And the broader context is that especially if we look over the last 5 years, companies have gotten so much better. They have lower debt, they have higher profit margins, they have higher return on equity. This means that quality is so much higher than it was 10 years ago, 15 years ago, 20 years ago. I've recently seen some research published that indicated that S&P 500 profit margins are 3 times higher today than they were in the 80s. So any long-term valuation multiple, any long-term valuation multiple is going to be using data from a time in which corporations just weren't of that high quality. So you are comparing apples to oranges in a lot of these cases. And again, we shouldn't be that surprised. Corporations have been through some very, very significant turbulence over the last 5 years and yet produced higher earnings every single year. We had COVID, we had the supply chain deficit, there wasn't enough stuff. Then we had the bullwhip effect, too much stuff. Then we had rising inflation. Then we had the fastest rate hikes in history. And then we had tariffs, and then we had the bombing in Iran. We've seen some significant economic and geopolitical events that in other eras would have caused a recession or would have caused earnings growth to slow down. In this case, in speaking specifically to corporate America, it hasn't missed a beat. So the bottom line is that if quality is higher and profit margins are higher, etc., then it makes no sense that valuations would be the same level they were in the past. They need to be higher because that's just logical. Now, they can of course get too high, but I don't frankly think we're there yet. Again, that is just my individual humble opinion and my judgment based on, again, assessment based on the current situation. So we would expect multiples to be higher.